Great. McGladrey, we're the 5th largest accounting firm. We have about 100 offices. We have about 55 people here. We do a lot of work with the clinic in this area, and we do a lot of work with businesses as well, and have worked with a number of startups in a number of areas. So before I go around, I guess we'll introduce ourselves. My name is Dave Oath. I'm a tax partner with the firm. Been up in Rochester about 25 years. Moved up here. I had to spend some time with Pioneer, which is sort of a high-tech company in the seed corn area, so I know the importance of research in that area. But my whole job is doing taxes. So, Dan?
Yeah, I'm Dan Edwards, and I'm a tax director. Also very similar to Dave. All taxes is pretty much what I do. I've been here in Rochester about 19 years. Came from the Chicago area.
And I'm Joellen Frederickson. I'm in the Entrepreneurial Services Group, which used to be called the Small Business Group. And we do everything from bank reconciliations, payroll taxes, sales taxes, financial statements, general ledger, trial balance compilation for the tax return preparation, things like that.
It actually works with companies the size that they're not big enough to have their own accounting department yet.
Right.
Well, Shadi had sort of given us some input in terms of what the group might want to hear about, and we talked about a number of areas, but the two that seem to have some attention, one is just sort of the nuts and bolts of all the various compliance requirements you have of running a business, payroll, sales tax, whatever. And then the other topic that we were going to talk about was on some of the incentives that are in there for basically companies to get started in the tax area. And I'm sure we'll touch on some other issues along the way about, or perhaps entity selection and things like that. And it's intended to be very general, or not in general, but what I meant to say was informal. So just pop your hand up or just speak up if you have a question.
We could move down to get you onto the table if you'd like. You're sitting balancing on your lap. We're all happy to help you.
There's plenty of room. That would make some sense. Thank you.
Thank you.
And Dan's going to cover the first part with any assistance necessary to Joellen, and then I'll cover the part on incentives. So,
Why don't we'll start on payroll taxes. This is, some of it is just very general, but I think a lot of times, even though it's general, I hope that you'll get something out of it. Don't know where each of you are at various stages in your business. You may have employees, you may not have employees yet. You may be collecting sales tax, you may not have to collect sales tax yet. So I'm just gonna go through it. I hope it's not too basic for you, and the same with the income tax. So what I've tried to do is, the handout that you have is just, I've given some links to some websites there that have more information if you need more information. And just starting out with payroll taxes, the first one there is the employer's tax guide, which is I don't know how many pages it is. It's a pretty long tax guide for most that you need to know for federal employment taxes. The first thing I have on there, starting out a business, many of you, would have already done this, just getting a federal ID number. There's not much you can do as a business without your federal ID number. You can't even open a bank account, so it'd be kind of the first thing you do. It can be done online. It's a form SS4, and then you also want to get your state withholding ID number, state unemployment insurance account number. And then you also want to, once you have employees, obtain workers' compensation insurance.
I have one item on the state unemployment. They won't give you a number until you've actually paid wages. So it's not like these other ones that you can get right away. The state unemployment one, you have to have already paid wages. I do not know why that is. Does anybody know? I do not know, but it's not like you have to wait until you pay wages.
So one question, so we should just ask questions
Yes,
along
please.
with it. So on the employment thing, so let's say you're starting out, you're a physician, and you're not ready to hire somebody, but you need some work done. And so could you just 1099?
That's one of the things I'm going to talk about.
Okay, is that gonna be
Yep,
later on? Okay.
I'm going to go through that because that's quite common.
Yeah.
But it is an area that you want to be careful of.
Yeah.
Yep, and I've got that in a couple points. So why don't I just keep going, and I'll I'll get to that.
Can I ask a question as well?
Yeah.
So that's assumed as a corporation, right? What about the LLC, is a pass-through, if it's a pass-through?
Same thing, if you have employees,
Okay.
yep, it doesn't matter whether you're a pass-through or whether you're a C corporation, you're gonna need to treat your employees the same.
So if you are the owner of a partnership, or you're just a sole proprietorship, you don't have to pay yourself wages.
Right.
It's only if you then hire
Hire
someone
them,
else
Mhm.
to help you, so.
Yep.
And the other thing, when you're starting out in Rochester, obviously, EIN number, federal, your state ID, and then is there any registration with the city? I mean, if you're like a little, have some ideas about a biotech company, you're just one guy, one person, but you're just maybe writing a business plan, and maybe you have $1,000 in your account, do you need to register with the local government?
I'm not aware of any business permitting process
You don't need any
in
of that.
Rochester. I know there's some states, like Philadelphia is a pain to deal with, where
Yeah.
you have to get a permit to do that, but I'm not aware of anything, unless you're in like the restaurant business or things like that, where you have to be
Yeah.
inspected and
Yeah.
that kind of thing.
Okay, good, that's
Okay, the next section just talks about what you say you're gonna hire your first employee or employees, what you need to get from them. And the one is a Form W-4, which is an employee's withholding allowance, and that, what they're doing is they're telling you how much tax they need withheld. I mean, and each of you maybe as employees have filled these out in the past also. The other one is an I-9, which is an employment eligibility verification. And that's just to make sure that they're qualified to be an employee, that they're a citizen or a resident alien, or that they would qualify. And that's, that form, you need to get proof from them, either like through a passport, driver's license, social security card. They have a list of what documents qualify. There's, Joellen was saying there's a new hire form for Minnesota that you need to fill out now for an employee, that's done electronically.
It's been around for a while. You can fax it to, the Minnesota website probably has information on it, but I think it's easier to just fill it out online, but you can handwrite the form and fax it to them. And I think it's just a census thing. They just wanna know hiring tendencies or trends in hiring and stuff.
Okay, then the next one is what you had a question on, is that's just classifying workers correctly. And it's a question of whether they're an independent contractor or are they an employee. And I've got again a link there that you could go to the IRS and what they kind of have, and it's pretty extensive. I mean, it used to be, I know we used to always refer to it as 20 points, but as I look at my list here, it looks like it's maybe more than 20 points now. But there's a number of things that you look at, and the thing with it is by flunking one of them or not passing one of them doesn't mean that automatically they're an employee. You're going to look at all of them, and it's not hard and fast, but it's going to be kind of a judgmental thing. But I think there's some of them where it should become pretty clear whether they're an employee or not. And I'm just going to go through a few of those. They break them down into three categories. One is behavioral control, one is financial control, and one is just the type of relationship. So under behavioral control, what they look to is, you have somebody working for you, what type of instruction are you giving them? Like with an employee, you're pretty much telling them what to do, when to do, how to do it. Whereas with an independent contractor, they'd say, this is the result I need, and how you do it, when you do it, how you achieve it. I'm not that interested in, but I'm gonna pay you to get this result, and this is what I want you to do. So that would be like the behavioral control, would be the degree of instruction, how they're evaluated. Typically an independent contractor, you wouldn't evaluate them so much. You just say, did you get the job done? I'm gonna pay you to get the job done. Whereas an employee would be evaluated, how are you doing, things like that. The other one would be training. An employee would typically have You may provide training, whereas an independent contractor, you'd expect them to be trained and be able to get the job done for you. So that's the behavioral control.
One other item maybe under there would be, do they bring their own tools or, you know,
Equipment.
provide their own equipment
Yeah.
to do it? Or is it all owned by you? You know, your calculators or computers or whatever, or are they bringing their own tools or
Yeah.
things
They
to
actually
the
list that
game?
under the financial controls.
Oh.
Where they
I
say, they
figured that would
consider
be-
that as significant investment. They're saying, would the, you know, does the independent contractor have a significant investment in the tools and the equipment or things like that? Or are they just coming to your place and using everything? And again, it's not hard and fast, but these are gonna be the type of things that they're going to look at. Unreimbursed expenses, again, an independent contractor would kind of incur his own expenses, do what he has to do to get it done, whereas an employee would expect to be reimbursed for kind of out-of-pocket things like that. Is there an opportunity for profit or loss? On an independent contractor, you know, they're in business for themselves, so there should be some risk there of, where they could, you know, if things don't go right, you know, maybe they may not make money on this job, whereas an employee is just, you know, typically paid a wage or paid so much, so that's another thing they look at. Another one is, you know, are your services available to a market? As an independent contractor, you typically have business cards and you'd be maybe providing these services to others or similar services to others. Do you do that, or is this the only place that you work and the only thing you do? Method of payment, are you know, employees are typically paid on an hourly basis or a salary and paid every so often, whereas an independent contractor is typically paid when the job is done. So those would be the financial ones that they list. Then the type of relationship, again, you know, and many times you might have a written contract. Now, an employee could have an employment agreement, an independent contractor could have a contract, but they're going to look to those to see if your type of written agreement lends itself more to an independent contractor or to an employment relationship. And this could be an area where if you have some concern about it, you know, you might want to write a contract, you know, kind of just saying this is an independent contractor relationship. That's not going to be foolproof, but it would show your intent, and it would also, you know, may offer you some protection, because we've seen instances where in the past where someone may, you know, you've been treating them as an independent contractor maybe for quite a period of time, and all of a sudden they say, you know, well, I should be an employee. I should have been getting health insurance, or, you know, so it'd be some protection for you just from the start to show, you know, what this relationship is intended and get it, you know, signed by both parties ahead of time. Employee benefits, again, employee typically gets employee benefits, an independent contractor wouldn't. And then just the permanency of the relationship, you know, an independent contractor, you usually hire them to do a job, you know, and then you may hire someone else to do the next job, or it's just not a permanent thing, whereas an employee is more of an ongoing relationship. So those are the types of things.
That checklist is on this link
That's
right
that
there.
link, yep.
Here's a question for you, since so many of us are male-related and some of us are male employee entrepreneurial programs, this new entity. So most of us will be contracting to male people, like we have two contract employees, as Dan knows, and they work at Mayo, and in their off time, they do work for us. And we rent space at Mayo for them to do that at the moment. We just built out downstairs, so we are providing the space for them to work. I mean, what's going to happen if somebody comes and audits us? I mean, what do they do?
Well, they're gonna look to all these factors, and that's why I say, the more you can go through, and a lot of times it's just knowing the factors that they're going to look at. And there may be things that you could do ahead of time to, you know, in your favor, so that when they do look at them, like a written contract or something like that, but a lot of these, you know, could have, you know, where you know ahead of time, like use of equipment. It's like, you know, rather than you providing them with a laptop, you say, you know, you're required to have your own laptop for this, and just, or whatever it is, you know, try to work it so you're meeting as many of these as possible.
The IRS thinks there's a lot of money in this area. I mean, you know, on all the lists where they think there's money going through the cracks, this is usually on one of the top 3 or 4 items. Because nobody wants to, especially when you get started, wants to deal with, you know, all the employee withholding, all that kind of stuff. And then the IRS is worried that the person doing the services doesn't always report the income, you know. And so it is a risk that I think small companies take a lot without knowing how serious of a risk it is. Generally, the IRS, you know, say, where does the pendulum swing? The IRS tries to swing toward the employee. I mean, that's their desired answer, you know, so.
So if you have a situation where, let's say you leverage some of these kids over here, over in the student center, and you had data entry, and you said, you got your own laptop, you can work over in the dorms, I'll pay you $10 an hour, but you can work whenever you want, and here's the work, and you can work in the middle of the night, you can work during the day, and you don't even have to work, you can just work, you know, 5 hours a week to 50 hours a week, whatever you want. Would that be considered 1099able, or is that?
Well, it's a good start, you know, it'd be better if you didn't pay them by the hour.
By the hour,
If you could pay them by
yeah.
I mean, it's
Yeah.
the things like that, and like I said, you know, paying them by the hour wouldn't necessarily cause it,
Yeah.
you know, to do it, but the more you can get on your side,
Yeah.
the better. I think, you know, the fact that they can do it off-site, the fact that they're not
Their
using your
equipment,
equipment,
Yeah,
and things like that, so.
And then having an agreement
having an agreement would be nice
that
too.
both parties say
Okay, that's,
that it's an independent contractor relationship would go a long way. You know, the IRS, generally, if you file a 1099, you know, it's more than $600,
yeah,
they might make the change, but they'd make it prospectively. You have a better chance if you just ignore it and, you know,
Okay.
write them a check, but don't file 1099, you're asking
Yeah.
for it.
and so the negative consequences, you don't pay double taxation on FICA, is that what it is?
Well, you're, as an employer, you're required to pay half the FICA.
Half the FICA, yeah.
Employee pays half the FICA, so you wouldn't pay your half of the FICA.
Yeah,
But I think it's, you know, this is very crucial to the employer, because you know, like Dave was saying, if they don't file their taxes and they come and audit you, I think, you know, they're gonna come to you for that FICA tax if they determine they're an employee. If they make the determination they're an independent contractor and they don't file their taxes, that's an issue. But if you know, if they come in and say they were in fact an employee, they're gonna say, you know, you haven't been paying your half of the FICA tax and things like that. So it
And the
is very,
unemployment, there'd be
right.
unemployment also.
But it affects the economic deal though, because if you're willing to pay them $11 as an independent contractor, you might only be willing to pay them $10 if they're an employee.
that's right. That's
You know.
right, yeah, so.
So,
That's
Another
very
one,
interesting,
another one that we just ran into with a company, it was interesting because they were actually audited by the state of Minnesota, not the federal government, not the IRS. And we went through all this, and she had a checklist, and she went through all this. And we got done, and she says, well, we're looking at this to see if it's an independent contractor. And I said, well, you know, what does it matter? Because the state of Minnesota doesn't have FICA, or, you know, I mean, it should be the same. And she says, well, if we reclassify them as an employee, it's a 3% tax. And I said, a tax? Yeah, I said, you mean a penalty? Well, she says, we call it a tax. I mean, it was just, you know, it's pretty much a 3% fine if you know, which it seems strange because the state of Minnesota is getting their tax on it either way, but they're just, you know.
well, the other thing you need to be aware of, it's not just taxes, and I have seen this come up where somebody gets injured, and now all of a sudden, the independent contractors thinks they're an employee and they ought to qualify for workers' comp. So sometimes it can not even be a tax issue, it can backdoor from liability exposure. So you want to really think about it before you do it.
That's right.
You know, in terms of the position you
No.
take. So.
One of the things that we're kind of in the process of going through, internships, paid internships. So they classify as an employee if we don't give them enough, if we don't provide them with certain parameters, or do they classify as a 1099 that's getting a check? Or are they in that middle gray area where you kind of have to just make a determination? Because they're not long-term, they're not permanent employees, it's for a determined or a finite amount of time.
Whether it's long-term or not really has no issue in terms of classification.
Okay.
You know, in an internship, we had interns, we treat them as W-2
As
employees.
employees,
Since there's no special class because
I think you'd really have to, because an intern wouldn't,
have the experience.
No,
or
you-
to be an
teacher.
independent
You'd
contractor.
be directing all their work, training them to do,
I think you'd probably. pretty much
reviewing
just-
everything they did and.
Now, is it an agreement enough? So you want the contractor to use your equipment because it's proprietary information, and at the end of the contract, you don't want your proprietary information on their personal equipment, and you just have to take their word
Yeah,
that they
and
deleted it.
that's a good set of circumstances why you'd have them use your equipment. But if it's a laptop, you know, and there's no, you know, they're just doing data entry or something, then there's not. But that's why I say you look at all the facts and circumstances. So I think in a situation like that, you have a pretty good argument that this is why they're using our equipment, you know, for this reason. So, but then you just, you know, you wanna go through all the other factors and try to meet as many of those as you can.
But I mean, so in those cases, though, would an agreement be, excuse me, be enough? Say, look, at the onset of the initialization of this relationship, both parties said, we understand this is a contractual, or a contractor-based relationship.
It can only help you, it can't hurt you.
Okay,
So I mean, I would have an agreement, it might not carry the day, but it can hurt you. It can
Okay.
help you.
Right.
So,
Yeah.
there's actually a form, it's funny, I've never seen this used, but if there's a disagreement or you just don't know, there's a form SS8 that you can actually send to the IRS, and supposedly they'll rule on it. I've never, in my 30 years, ever submitted that form SS8. That's a good resource too, you can almost answer the question, sort of point you in the direction of which way it falls.
So the IRS actually has the final say on whether or not this is a employee relationship.
Yes.
And then if you don't do it right, by the end of the year, they come to audit you, it's too late.
Right, usually it'll show up 15 months or 18 months later, you know, on audit. So at that point, now you have probably 2 years that could be an issue, and now you have penalties and interest. I've had clients that, well, they ran a seminar business, and so they bring people in to host the seminar. And anyway, they said that they should have been treated as employees, and it was $70,000-$80,000 deal.
Regardless of your contract, that one day that everybody signed and say, I'm your contractor.
Right, but the contract won't carry the day, it will help, but it won't carry the day necessarily.
So your general recommendation is just, if it's questionable, make them an employee, 10 to 5, a W-2 employee.
You know, in the end, I think most cases, the IRS would probably say that they're an employee.
Really?
Yeah, unless they're providing their own equipment and they're just saying, hey, this is the job, you can do it at home, you can do it wherever, but if they're on your location.
Or
and
they're
you're saying-
running their own business. and
Or they're running their own
they're
business.
like a person that goes and cleans houses for people. They do it for more than just you. You know, they go and can do, you know, go clean anybody's house.
And that's pretty strong
You know,
indication.
they're holding themselves out as
That's
a
right.
business
Right.
too, where they wanna be hired by more than, they wanna make a living doing it. You know.
And in those cases, it's pretty,
Then it would be, I would say it's
Clear.
NI, yeah, right.
Okay, well, I'll keep going. If you think of other questions later, feel free to ask, or we can talk afterwards also, but I'll just keep going. The next point is just having a payroll schedule, so whether you pay them weekly, bi-weekly, semi-monthly, or monthly. The payment method, most all payroll now is a direct deposit. You don't see too many people issuing checks anymore. And then just deducting the amount from the employee's wages based on the W-4 that they fill out. Tells you how much they want withheld and paying the Medicare, Social Security taxes, state taxes. Some locations might have a local tax, a city tax, or things like that. So depending on where they're working, you'd have to look at that also. Then any other deductions, they'd requirement if you have a healthcare or retirement plan or things like that. And then, as I mentioned before, the FICA match, the employee pays half and the employer pays half. You know, they have state and federal unemployment. And then, like I said, other state and local taxes based on where the work is performed. And this is This is one that's, you know, 10, 15 years ago, just wasn't as prevalent, but it probably should have been, and now all the states are wanting their revenue, so you have to be really careful about it, about where the work is performed. And we have an office in La Crosse. If I were to go to our La Crosse office and work for the day, those are Wisconsin wages for me. At the end of the year, on my W-2, it's allocated how much was Wisconsin withholding, things like that. It applies to, you know, any of your employees wherever they're working. It does need to be work. If you sent them to a seminar or something like that, or a training class or something, you know, there are exceptions to that. But if they're doing work for the company, it needs to be based on the location where the work is done. So another one to keep in mind, you wouldn't want somebody working in La Crosse for years and then, you know, they come to find out, Wisconsin finds out you had this employee, they'll go back and say, you know, where's our share of the earnings, so one to keep in mind. And then your filings and deposits, I have them listed there, you know, they list the Form 8109, but I think that's just no longer in use, is that right, Joanne? Just electronic?
They require you to file electronically
Yeah.
on the EFTPS system. And one thing I wanna say, this is the liability, not the gross wages that's on here.
Yeah.
It's the
50,000
amount of
in liability.
liability, which is the employer match, the employee portion of FICA and Medicare and federal withholding.
So most startups initially will just be monthly.
They'll set you up when you, even regardless of what you think you're gonna pay, I think you can, they set you up monthly to start with. And then they'll have a look-back period after so long.
Yeah.
And they'll, you know, if you're over this $50,000 liability for a certain, whatever the look-back period
It's a
is.
year.
It's either 9 months or a year. They'll change you to semi-weekly.
And
So
that's,
typically, you do payroll, and then you get your totals, and then you send them in, is that that's how you do it, basically?
Yep.
You don't do estimates, but you actually do actuals.
Yeah,
Yeah.
no, it's just based on the payroll. Most payroll programs,
Yeah,
most of, I would assume, would be computerized payroll programs.
yeah.
And there's just a report, a liability report. You
Send
just
it.
would go to the EFTPS site and you
Send it in.
fill out their form, and it would be withdrawn from your bank account on the settlement date that you put in there. And the state has the same thing, state
Yeah.
withholding and unemployment.
yeah, and that's, then you report, your 941s are quarterly reporting, just how much wages and withholdings that you had, and you file that by the last day of the month following the end of the quarter. The 940, which is federal unemployment, is an annual filing, but you pay it quarterly. And then, as Joellen said, the states are, you know, similar to the federal. It's deposited semi-weekly or monthly, depending on your levels, but they are lower thresholds than the federal level.
Most people, if they're one for federal, they follow the same for the state regardless, because it's just easier than
Yeah.
having, say you're semi-weekly for the federal and you're monthly for the state, well, then you gotta remember to do both. It's just easier to do them both at the same time, easier.
And then just your year-end documents, if they're an employee, they're gonna get a W-2, you're gonna file a W-3 with all the W-2s behind it. Same thing, 1099s, go to all your independent contractors. You wanna remember to file those, 600, if you pay them more than $600. And then a 1096 is the reporting form to the IRS. And the last point I have there is you may consider using a payroll service. It's, the cost of using a payroll service has come down so low. I mean, we do it, there's other companies, ADP that do it, and they you know, they do a really good job, and it's just become automated, and it's, you know, a lot of times it's worth, if you can spend your time doing something else with your business, payroll may not be something that you wanna spend your time doing, so I'd kinda suggest it.
No, the one thing on the 1099s, if you do have contract employees, Dan mentioned you should get a W-4 if they're an employee. The form for an independent contractor is a W-9. And if you don't get a W-9 and you don't file the 1099, they can come in, the penalty is like $200 per 1099. But what they really get you on is if you can't prove that you had this W-9, which basically says that your independent contractor's social security number is this, and they, you know, sign it off. If you don't have that, then they can get you for a 28% penalty. Because you should have withheld, because you didn't have their ID number before you made the payment. And that's one that, you know, so if IRS wants to be nasty, they can on these audits.
So you just keep that on file, the
Yeah.
W-9.
It's 79. So if you do have, you know, independent contractors, be sure you
Yeah.
have an agreement that you suggested, and also get a W-9 on the front end. Otherwise, it's hard, especially with students, you might not be able to find them at the end of the year.
That's right, yeah.
Right.
That's right.
And if you didn't get their social security number or their address,
So they sign it,
yeah, they should
Yeah.
fill it out, that their name, it should be their name, address, and either, if it's a individual, it should be a social security number. If they do have their own business, it would be a federal ID number.
So if the company just started zero revenue, did not pay out anything, does the company have to file any forms?
Well, your income tax forms, if you're, you know, if you're a corporation, there's not a filing level. If you're a partnership, there's not a filing level. You really should be filing income tax forms, but if you don't have employees, there's nothing you'd have to file for employees.
But it's not based on revenue. If you have employees, even if you don't have
Right.
revenue,
Right,
you still would be subject to all these filings, because you're paying them the wages and you're withholding FICA and Medicare, and you'd have to pay in those amounts.
Yeah. Okay, the next topic is sales tax, and I'm not gonna go into a lot of detail with this. I've given kind of three references. There's the main one is, well, there's just a website, the Minnesota website, that you can get links to all the things. But there's the Minnesota Sales and Use Tax booklet, and this is, you know, it kind of has a section, what is taxable, what is not taxable. You might, you know, if you have any questions, you can go through there. If this is, you know, somewhat more general, if you can't find it there, they have these fact sheets. These fact sheets are kind of by industry, so if you could find your industry, you could kind of know whether what you're doing would be subject to sales tax or not, and they're very helpful. Other than that, your sales tax is on the sales that you have. Go ahead.
On that note, for us, our company, everything we sell is to researchers or institutions, nonprofit institutions. So I'm assuming we would never have any sales tax.
Well, you want to make sure that the institute, that you're not required to charge it just because, you know, they're a nonprofit. There are, you know, like in Minnesota here, just because you're a nonprofit doesn't necessarily mean you don't pay sales tax. Even as a C3, some C3 organizations pay sales tax, some don't. I think that's true with Mayo Clinic.
I mean, and the first thing would be, is the sale taxable? And then the other one, you know, like in your case, I bet a lot of them are outside the state. You don't have, if you're shipping a reagent or something, you don't have to pay sales tax, you know, for a shipment to a customer in Texas or New York. And you probably don't have a liability there because you don't have an office or presence, you know, in those states.
Is that the rule? If you have a presence, in that state, you charge sales tax? That's the whole Amazon situation?
Yeah, that's where the big stink is right
Yeah.
now,
Yeah.
and that's why Amazon is, you know, like they're using it as leverage, we're not gonna open up a warehouse there.
Yeah, that's right.
Because-
So if you're just here in the accelerator and you're selling all over the country, you pay only to the customers you sell it in Minnesota.
Assuming it's a taxable sale.
Assuming it's taxable.
Yeah.
Okay,
And that's if you don't have a physical, that's what I've got down here, that they call it nexus. And if you don't have a physical presence there, there's other things that could cause you to have to charge sales tax into the state. If you have people going into the state, or, you know, and all the states are different, so you really have to kind of look at the state. But you need to be careful, just because they don't have a physical presence there, you could do something that could cause you to have to collect sales tax in that state. So I just say be careful about it.
One of the things you can do to cause that to happen.
Yeah, I think, you know, I don't know, if your truck's going, if you have trucks in the
You generally have to
state.
have some type of presence in the state, not going to a research seminar or anything like that. I mean, you need to have sort of bricks and mortar or employees that are regularly going into that state. Otherwise, I think you're gonna be okay in most cases.
Yeah.
So what about, like traveling salesman type scenario? They drive into the state, make a sale, drive right back out.
It would depend
It
upon the
varies,
state.
it varies by state,
Okay.
yeah, you really, but I'd just say be careful.
We have people, all they do is sales and use tax, and we're not one of them. But I understand the issue, but I don't know the answer. So,
Okay.
get you an answer if we had a bit or specific tax.
Do you know, and maybe there is there a software tool that allows, that kind of calculates or updates what those are state by state, and what those rules are, and tells you if you qualify for that? The reason I'm thinking is, because we sell both a hardware tool and a software tool component. Well, the hardware tool in the state of Minnesota would be taxable, software wouldn't. But how does that comply when we're transferring to Iowa or going to Wisconsin, or, you know? So, and then do you have to pay state and county, or is it just state, or how, you know, what are those?
Yeah, when you get to a certain size, there are a number of commercial applications. Vertex is one, for
Okay.
example. Basically you buy the software, it's got a database, you enter the zip code, the whole 9 yards. But that can be exactly the case. There can be a state, there can be a local tax.
Because I mean, that would affect the way you would price the product when you wrote the invoice.
Right.
So, you know, I just, if there's all those different layers and you're charging $100, the next thing you know, you find out you got 2% on top of that, on top of that, on top of that. Well, all of a sudden your $100 now becomes significantly less. And obviously that's with taxes, but if there was a way to calculate that out or know that in advance, because we don't know if we're gonna be making a sale in Wabasha County in Wisconsin, or if we're making one up in the Iron Range in the same day, you know, how do you, those prices are gonna vary a little bit.
Well, it
Well,
would
you
still
should just be-
technically be your the
Right.
$100 would still be your revenue though, because
just
you're
collecting the
collecting it
tax.
from them.
And remitting
But
it.
if you don't collect on the front end, it's hard to get.
Right,
Right,
I can't go
right, you
back
have
to them
to-
and say, oh, we forgot
No.
to give you the $47 tax.
Right,
Yeah.
you have to collect it
Yeah.
from them
And that's what I'm
upfront.
saying, is that you'd have to be able to calculate that out, and if you're sitting down and they're just signing a purchase agreement, you know, how do you, is there a resource that you could go to without having to go to every individual state and county's website to figure out what those tax implications are?
There are some out there, but they tend to be a little bit industrial sized.
Okay.
Might not be, you know, afterwards we can talk maybe and get us your specific question, we might be able to get an
Okay.
answer, but generally it's gonna depend upon how much activity you have in the state. Now, just having a salesman go in, I don't know if that's enough or not, but it could in some cases.
Inside sales. Everyone's inside sales.
Another thing I'll mention is, and I've got the annual filing levels there. Another thing I'll mention is that there is something that, and it may be something that you use, it may have something that you're presented with, but in Minnesota, it's an ST, I think it's an ST3 form, it's a resale certificate. So if you're buying product that's going to become part of your product that you sell, so you're going to resell it, you don't have to pay sales tax on it. And you may have the same thing, you may be selling something to somebody, and if they're going to resell it, or it's gonna become part of their product, they don't have to pay sales tax on it. So they would give you this exemption certificate, it's called a resale certificate, with their name, ID number, and it's, issued by the state. And that would, allow you, your proof that you didn't have to collect the sales tax from them.
So that is regardless of the added value. So you buy it for $100, but you sell for $200, but you don't pay anything.
Yep,
Not in,
because it'll be collected on the $200 sale. So what they're saying is they don't require it to be collected on the $100 sale and then the $200 sale. So they don't want it doubled up. It's a matter of paying tax twice on one product.
for your selling only once, right? The sales tax would be when you're selling for $200, but when you buy it for $100, you don't pay. They don't pay. The
Right,
seller don't pay.
right, because they're gonna resell it. Correct. Yep. Yep, so that's important to know and important to document. The other one I mentioned up there is just use tax. And, many people aren't aware of use tax, but use taxes, it's kind of, we're talking about the Amazon situation. If you buy something from another state and don't pay sales tax on it, bring it into Minnesota, use it in your business, even use it individually. The limit individually, I think is $770, I think. So say you buy, expensive set of golf clubs or tennis rackets or something like that, bring them in, it's more than $770, technically you're required to remit to Minnesota the tax on, sales tax on that purchase. It's the same with your business. If you buy office furniture or whatever you buy for your business and it's shipped into Minnesota, you use it in Minnesota, you don't pay sales tax on it, you're required to remit that. And this is one that they audit.
A lot, actually.
A lot.
Well, how would they know?
Well, what they do is they come in, they just look at all your disbursements. And so if you're a business where you buy a bunch of, I don't know, cotton gauze or whatever.
Office
it-
copying,
it's-
the office supplies
you know,
is a big one.
they basically just pull out
You know?
invoices, and then if there's not sales tax on it, they say you should have paid use tax. And it's, I mean, honestly, this is the one where I think, there's probably more, you know, not huge exposure, but rarely does somebody get audited, they don't have to write a check. Because it's just not high on people's radar screens, you know, I bought it, why should I have to worry about anything further, you know?
What if I bought it in Minnesota? Let's say I go over to Schmidt Goodman and bought all sorts of office equipment for our office.
They should know, that they should collect it.
They collect
But
sales
if
tax.
you have
on
given
that.
them, there's another certificate, like nonprofits can get, or isn't there an ST8 or something?
But there is an exemption for certain purchases by nonprofits.
Right, but if you have that with a vendor, and for some items that wouldn't be taxable, because you're gonna use them, but
Consumable.
office supplies should be.
Generally, they
Sometimes the
should
vendor
collect it.
doesn't know to charge sales tax on some things and not others.
So they charge, if you buy something, they charge sales tax, you're fine with that.
Right,
That's right.
Then you go over to
that's,
Staples and they give you 10 or whatever, 7%.
absolutely.
Well, it's funny, and states are different, but Minnesota, it's sort of voluntary on individual, you know, I mean, it's required, but anybody here file a use tax?
I have
So
never.
anyway, the compliance, that's about the right average, I think.
Yeah, yeah.
And anyway, in Wisconsin, it's part of their income tax return. Arizona is part of their income tax return, so they're basically forcing the preparer to ask Gene, we got a use tax to pay? You know, and in Wisconsin, they went after lawyers and accountants, and made them sort of a public example, so ratchet up the compliance a little bit.
Okay.
Now what's the rate in Minnesota for use tax?
It's the exact same rate as the sales tax you pay,
Okay.
so what is it?
6.875
That includes
for the
Rochester?
state.
That's the state.
Rochester is another 0.5%, and Olmsted County now has another 0.25% for transit, Olmsted County transit tax or something. It just started January
Or DMC.
2014.
So is that like car, like, what is that?
It's a load tax, isn't it?
Call it a wheelage tax, but isn't it just like a sales tax?
Yes, it's the same as like the Rochester additional 0.5%.
just another
if
sales
you're-
tax.
If
They
you're
call it something
located in
else.
Olmsted County and your sales, like a restaurant or a store, like Ace Hardware or
So it's
something,
roughly
everything.
7.5%.
They have to charge that extra, or they have to collect that extra 0.25% in Olmsted County.
That's why they're actually
Olmsted
trying to
County.
get a national solution on this, because it's out of hand, you know. There's so much stuff over the internet or whatever, and they realize people aren't gonna comply, so they're trying to get a national solution where basically Congress will require these online places that collect sales tax. So,
So the answer was that there's really no kind of benefit to intentionally doing it one way or the other. You know, and just even if you knew it was going to qualify for use tax, pay the sales tax. So that it's a wash either way.
It's a wash either way
Okay.
unless you just don't comply,
Okay.
you know.
Okay, move on to income taxes. And income taxes, it kind of depends how you're structured. So the first point I've got there is a C corporation, the income's taxed at the corporate level. Losses remain in the corporation, so you as an owner, you may not get benefit of those losses, you wouldn't get immediate benefit of those losses, they would just be within the C corporation to offset future income. That's your S corporation partnership LLC, those are what we refer to as flow-through entities, because the income and losses would flow through to the owner's individual income tax return. So there, you make, you know, if you have some startup losses, many times a startup business has startup losses, and the owners would get a benefit of those. I'll talk a little bit more about that later, but, so it's you know, there's advantages and disadvantages to both. I'd say, you know, we see, you know, in our practice, most of our clients are partnerships, LLCs or S corporations. We don't see, you know, many C corporations. There could be a double tax to be in a C corporation, because it can be taxed at the entity level, and when you liquidate the corporation, you could have another tax, whereas you don't have that on the flow-through entities. But you really have to, something that you have to look at for your own situation and where you're gonna be in the future. Are you gonna be bringing in more people, or, you know, there's a lot of issues. That's kind of a choice of entity discussion. But let's just talk, you know, like I said, startup companies typically incur losses. Can the owners benefit from that? As an S corp partnership LLC, you can deduct that on your individual return if you have basis in the corporation. We've heard of basis, you know, have you put money into the corporation? You know, if you just borrow money from the outside and you're not responsible for that debt, then you can't deduct your losses. But if you put money in either through contribution to capital or debt, then you can deduct those losses on your individual income tax return. So you need to look to see if you have basis, and it's something that you need to do year to year, track it on an ongoing basis. Even if you have basis in the entity, it still may be that you can't deduct your losses. There's what they call the passive activity loss rules, and you need to be active in the business. So if you're just an investor, considered more of an investor than an active person, your losses aren't gonna be deductible. If you're active in the business, you could deduct them, but if you're just putting money into it, it generates losses. Even though you put money into it, then again, your losses are gonna carry over and be available to offset future income. You don't lose them, but they're just not currently deductible. So, and typically it's a 500 hour, they look to see if you maybe spent 500 hours in this business. There are exceptions to that. If you had a number of small businesses and you spent, you know, 100 hours in each of them and got over the 500 on all of them. Or if you were, you know, if you didn't hit the 500, but you were really the primary person that did most of the work, then you qualify. So there are exceptions, but that's another one to watch out for. The last point there is just what expenses are deductible. I gave an IRS publication that, this is a question we just get, you know, many times somebody's starting a new business, they wanna know, you know, what can I deduct, and, you know, can I take my use of my car and things like that. And this publication will cover all those types of things. The next one is state taxes. You know, similar to sales taxes, you look to what we call as nexus, and you look to, you know, do you have property in the state? Do you pay payroll in the state, or do you have sales in the state? And typically, if you're just selling into the state, it wouldn't create nexus. But if you're selling into the state and you have employees in the state, or you're selling into the state and you have a location in the state, then you'd create nexus in that state, and you'd have to, you know, allocate your sales between Minnesota and Wisconsin or Iowa, things like that. And it can be quite burdensome for a flow-through entity, an S corp partnership or LLC, because if you get into a lot of states, the owners of the business have to file taxes in all those states. I've noted here, a composite tax filing may be available. What a composite return does, let's say you're a partnership or an S corporation, you've got 10 shareholders and you're in 10 different states. So to alleviate those 10 shareholders from filing in 10 different states, if the state offers it, the state will allow you to pay the tax on behalf of the shareholders. It's called a composite filing. So then the shareholders don't have to file in all those states. So, and it works well, you know, in the right circumstances, it really does work well, because as a corporation or the partnership, you're gonna have to file with that state anyway. So if you can file and pay tax for the shareholders and alleviate them having to file in all those states, it can work very well. The last one is just the due dates. Your corporations, Form 1120 is a C corporation, 1120S is an S corporation. March 15th is your due date for a calendar year corporation. partnerships LLCs file a 1065, April 15th, the due date. And then your individual income tax return, I think most of you are familiar with April 15th. So,
So on the LLC, so you'd run everything through a Schedule C, and if you make $10,000, you get taxed on the 10,000.
That's if you're a
Single
single
member.
member LLC,
LLC,
yep,
yeah.
it goes on your Schedule C, it's a good thing.
If you have a loss that year, you take 10%, I mean, you pay less tax for that year. And then with the S Corp, you fill out a tax return for your corporation, and then if you have a profit, you.
Goes to your individual owners.
Yeah.
Same thing, losses go to the individual owners, look to see if they have basis.
Yeah, so LLC is so simple, right? I mean, you just go to the state, takes a couple hours and you're all ready to, I mean, is there any benefit to an S Corp versus an LLC? I mean, there's some you can do some draws with the S Corp, is that right? Or?
Well, the one benefit, one of the benefits of the S corporation is that, let's say you earn $200,000. If you were a partnership or a single member LLC and you're acting in the business, you'd pay self-employment taxes on the entire $200,000.
Oh, okay.
If you're an S corporation, as long as you pay a reasonable salary, let's say a reasonable salary is $70,000.
Sure, yeah.
The $130,000 of income that's left won't be subject to the self-employment tax.
So that's one benefit.
Yeah.
Self-employment.
And then sometimes a corporation can do some tax-free reorganizations with other corporations
Okay,
that
yeah.
a partnership cannot always do. But
Yeah.
then there's also flexible things you do with partnerships as
Yeah.
well.
Yeah.
So,
So the self-employment tax, what would that, I mean, if you made 200K, what would that amount be?
well, up to about 113,000, it's basically, because part of its deductible is about a 12% tax.
12%.
So, it's say $14,000. And then the Medicare piece of that goes all the way up to 200, and that's like another 2.5%. So on 200,000, boy, it could be, $15,000, $16,000.
Wow, so that's pretty meaningful.
It can be in certain situations.
Yeah, okay, so that's probably the differentiator, the key, that self-employment tax then.
I think a lot of times that's what's motivating. Otherwise, we're seeing a lot of LLCs. I know, talked with some of you, and in some cases, if you're raising outside money with venture,
Yeah,
and I talked to one of the speakers, at the Accelerate event, and they said they don't want to touch anything but a C corporation.
that's right, yeah,
Because they don't want a K1 coming out that they have to deal with.
that's right.
So, every case is different.
Yeah.
A lot of times we see people go with an S corp or a partnership in startups because they don't know what the end game is, and they might lose $200,000.
That's right.
And they'd rather lose that at ordinary tax rates than a capital loss at the end.
Yeah, that's right.
So there's lots of pluses and
Now,
minuses.
is there any consideration as to when entity becomes entity upon itself?
You mean from just being a sole proprietorship?
As far as, like a corporation is recognized as an entity just as an individual, so they can enter contracts, they can be taxed, they can be sued, they can enter litigation, et cetera. Does that go all the way down to an LLC?
An LLC and a corporation are identical for legal purposes.
Okay, all right.
So, Jeff asked for single member LLCs. What about the multiple member LLCs? Let's say each of them put $10,000 into the corporation, into the LLC, I should say. So then, let's say 3 members did not hire any employees. So how do you treat?
Well, once you have more than one member of an LLC, now you're taxed as a partnership.
Okay.
And so you'd file a Form 1065 generally, and then you'd issue K1s that would say your share is X, your share is Y.
So it's K1.
Yeah.
I see.
So,
That's what we have. It's kind of based on their level of contribution, what percentage.
But
the
it's not a
company-
W-2 or a 1099 to the shareholders, it's this K-1.
So if we had like some of the local physicians, they kind of want to get into the startup game, and I mean, is it advisable just to say, go start an LLC, single member, just to reduce the complexity of starting an S corp, because it's so simple with the LLC.
Well, you know, actually forming the LLC or the S, I bet they're equal.
They are
Well,
equal.
they really,
Yeah.
you know, the single member LLC or the corporation, I think it's all about liability.
Yeah, okay, yeah,
And so by doing a single member LLC, it's pretty inexpensive insurance premium.
yeah,
And it doesn't complicate your tax life when there's only one owner.
yeah, that's right, that's right.
So, yeah, I mean, in fact, we're recommending, anybody who owns rental real estate, things like that, use a single member LLC
You
generally.
do, okay.
What are you, Shruti?
Secret.
So for, actually, along the line, if the physicians have a whatever LLC or partnerships, because the salary is pretty high already, they do not really have to pay FICA anymore, right?
Right, that issue is of lesser significance, because all they'll pay is the Medicare tax goes up forever.
Right.
You
Right.
know, Joe Mauer pays it in his entire 20 million salary, but
So that's where the self-employment would still hit you.
it's
all
just a
embedded.
smaller piece.
Smaller piece, okay. That's a good point.
Mhm.
Yeah.
So with the state filings, and I guess I'm asking specifically in the context of the C corporation, if you're doing contract work for people in other states, do you still, and I guess you're technically paid for the contract, you have to file in each state, or you have something that,
If they pay you to perform, say, services here in
no,
Minnesota,
it's the other way.
the other way,
Yeah, we're paying them.
oh, you're paying them.
Yeah, so because, and this was probably the case in a lot of biotechs, it's almost all learned for the first so many years, and you're paying for said services, whether it's, you know, finance, accounting, or manufacturing, whatever it is, to run clinical programs. And do you still have to file in separate states wherever these relationships may exist, or is it just,
No, you should, I mean, if they're not an
This
employee, you
should
don't
be
have
fine,
property
right?
there, I mean, should be okay, yeah.
Are you hearing much about these crowdsourcing websites where you can put a task out there and then people bid on it and then it's like, I'll do it for $1,000 and maybe it's software development? I mean, I think that's actually a pretty big area. Is that guaranteed 1099 in those scenarios, or maybe you haven't seen one?
I think it would be, you know, first of all, the 1099 has to be filed if it's for services,
Yeah.
and it's to an individual or a partnership. So unless it's an Inc. in their name,
Yeah.
then you'd have to file a 1099,
It's over 600.
and it's over 600.
And if it's overseas, if it'd be like, you know, because India and Russia now has, there's huge.
There's no requirement to.
That's just an expense then?
That's an expense.
And that would be like, that would be like development expense, or you just call it?
Just whatever you call it, if it's paid to a US person, that's.
Okay.
I don't want to take you too long, but the last page is just some incentives that you should be aware of for technology companies. And, you know, there's some very favorable rules for deductions. If it's a pass-through entity, the owners might say, boy, I'm funded $100,000. I'd like to save $40,000 in taxes, then it only costs me $60,000, okay? And the pass-through treatment would allow that. And they have some favorable rules in certain areas. There's, I don't have it written down, but there's favorable depreciation. Although some of that is ended on December 31st. We're talking with Gene, there's like a 50% bonus that could apply to like lease build-out. That stopped on January 1st. Before you could write off 100% of your equipment. This past year has been 50%. Even without that, you can write it off fairly quickly, probably write off 70% of the cost within the first 3 years. There's also a rule, section 179, that you can buy a piece of equipment and immediately expense it. But there's this period of time, maybe from 2001, since 9/11 to now, lots of stimulus going on, where you could write off stuff. A lot of that ended on January 1st. So now, last year, you could have written off 500,000 of equipment, now you could write off 25,000. So that's sort of put the brakes on in a hurry.
Plus you have to have income.
And here you have to have income, so you can't use this to increase your loss. Research and development, that's probably the biggest thing for a startup. In that, and there's a rule that we didn't talk about earlier, but when you're in a startup phase, you can't deduct losses until you open up. So if I'm opening up a restaurant and I'm I'm opening on February 1st, but I was training in November and December. I can't deduct any of that until the next year. But for research, that rule is off the table. And so a pre-opening company can deduct research, which is very favorable. You can deduct it, or you could elect to capitalize and amortize over time. And this is one where the answer might depend upon whether the money person is active in the business or not. If you're not active in a pass-through entity, for a thing called alternative minimum tax, you can't write off the R&D, you have to do it over 10 years. We call it AMT, or accountant's meal ticket, because it's really complicated, you have to hire us. So, but it's actually a pretty complicated deal. So anyway, the R&D, that's an election you need to make, and you need to think about that, seriously, how you want to handle that.
Can we go back to that, because we would be a good example of that. We've got, research and development going on, some being done by the contract people, and some being done by one of the Dr. Patricia Lett, who has a small portion. And I'm sure, I don't know if anybody else here is doing it. So how do you detect that? I mean, how do you
Well,
position yourself to be able to do something with that?
well, if it's true development, you're just not sure where it's gonna go, and, then you can deduct it like that.
Now, how do you base it on their time?
Well, it's whatever you wrote.
Whatever you.
So I mean, it's the checks you wrote, so it's not just the value of it, or, I mean, it's whatever you wrote to do the research. So you could quantify and say, Dan and I are teaming up, and Dan spent 500 hours, and we're gonna value his time at $100. We can't do that.
can't do that.
It's only if we wrote a check to Dan.
Okay. So it would be, it really does make a difference how you set up those people, whether they're contractor or they're employees.
Well,
No, because
either
the
way.
payroll expenses would count.
Yeah, whether it's a W-2 or a 1099 going out, it wouldn't change the answer.
What about if it's somebody like Patrizia who's not getting paid? I mean, she's got a percentage of the company.
Yeah, you wouldn't have any cost.
Okay.
Needs to be dollars, right?
Yeah, you can't monetize the value of the services unless you do it with a check.
Okay.
So,
How do they classify R&D? Is it up to each individual corporation or entity to determine if you're in R&D, or are there specific parameters at which you have to classify into?
few bullets down, they talk about 4 things. Basically, it has to be for a new improved product, function, quality, reliability. It has to be technological in nature. Has to be elimination of uncertainty. Has to be a process of experimentation. So,
It's pretty vague.
Well, it is pretty vague. But I mean, in general, if you don't really know what's at the end of the door, it's gonna count.
research. Okay.
It's research. I mean, it's pretty broad, and it's intended that way. It's intended to be an incentive for people to develop new things. So,
If they're funded through grant funding that the company receives, does that still,
I mean,
don't know how to say
basically, the grant would offset the expenses.
okay, so it's not, yeah.
You
The fact that it's
can't
fun-
double dip.
I was gonna say, I don't
Yeah.
think that would count, yeah.
Be nice. So
You
anyway,
could.
That's a very favorable rule, that before you even can sell the widget or sell the drug or sell the device, you can write off all your development costs, so, assuming that's a good thing that you want.
But again, that's only if you can monetize it by actually having a check stub.
Right. But you,
There are credits for research, although the federal expired on January 1st. But generally, there's a credit that is based upon increasing your research. So that can, and a rule of thumb is that it might end up being 6.5%, 7% of the amount involved. Though people use rules of thumb, don't have any thumbs anymore, but every case is different. But it is an incentive. Minnesota actually also has a research credit. That has not expired. So we should, in fact, Dan and I talked about, making sure that we look at claiming research credits, on these startups. You might not have any, if your C Corp might have any tax yet to pay, but these credits carry forward like 15 years. So you want to make sure that you're capturing that on the front end.
So once you bank them, they're waiting to be used.
So, and that would be any kind of development, like if you were developing software, that's R&D. So if you spent $100,000 on software development, you'd get a credit off that $100,000 spent. And that could have happened 5 years ago? Or does it have to be?
Well, it could have happened 5 years ago. I mean, you needed to have
Documented.
Yeah, you have to have it, of course, yeah.
completed it, but yeah, it carries forward like 50, is it 15 or 20? of a sudden, it's escaping me, but it's a long time.
Wow, that's great.
Now, this might, I don't know if this question really fits, but what happens if the research that you've conducted in a product that you've brought up to market is no longer viable? Once you bank the credit, it's there, it doesn't matter if it's still a viable product or if it's functional or not?
Exactly.
You still get the credit, okay. So I was just thinking in terms of software, 2-3 years from now, what we're developing today is not gonna be as used as.
Oh, no.
So I don't know if the research has to be an ongoing viable type of product before, if it's just sitting around.
In Minnesota, for a period, it's not now, but it was refundable, so even if you didn't have taxes, it was refundable.
Wow, you get money
So,
back.
yeah, so that's when you could even look at, I suppose, amending returns, if the returns are still, whichever is the last 3 years, so. You know, favorable tax rates for current operations, there's, a favorable thing there that if you get to the point where you're actually manufacturing the product or developing the software, you know, you're past the R&D, there's a deduction of 9% of the income. So it can lower if the top rate is 34% federally, it'll lower your rate by 3 percentage points. So that only matters if you have income, and you have to have wages as well. You know, incentives for your initial investment, there's a Minnesota Angel Tax Credit that if you qualify, you can get 25% of your investment. So if you invest at $100,000, you can get a refundable $25,000 from the state of Minnesota. So that's a pretty good thing. The thing is, you have to get the business certified beforehand, and the investor has to be certified beforehand.
They're qualified or accredited.
Well, it's not just an accredited investor concept, but it's some that, and it can't be, they're picking on us, can't be an accounting firm, it's gotta be a high-tech, you know, business. So you actually indicated you went through it, was it pretty easy to get through
Yeah,
the?
the form was easy to get through the investor qualification, I haven't done it yet, so I don't know how burdensome that is.
Yeah.
So you invest 100 and you get, they send you a check for 25%?
You have to file for it,
It's on your tax return, but you don't have to have tax to get the credit.
Okay. So-
but in Minnesota, I believe that it's a first come, first serve.
Yes.
So once
There's a limit.
once a
Once
lot
the
of the
money's
money's
gone.
gone, it's gone, so you
Yeah,
can't.
okay, yeah.
It's
That's
probably
good.
gonna be in March.
Yeah, my understanding is that goes usually in the first quarter.
Now, from a receiving company, you said you've gone through that, what's involved?
You
Just
have to
filling out
file a
form?
form, yeah,
Okay.
yeah, it's, there's a fee involved to file it, but yeah, it's just filling
It's
out.
like 200 or something?
150.
150.
And is it, you have to be an active business, can't just be, you know, holding 100 shares of IBM as a portfolio investment or active, you
Yeah.
have to be active, but
That's
it-
great.
It can work. There's also favorable rules for the exit strategy. Section 1202 is a code section, we love talking about code sections. But anyway, it allows you to exclude, and it's varied over time, anywhere from 50 to 100% of the gain if it's a qualified business, okay? And that this only applies if the company has been a C corporation for predominantly all of its life. So you talked about C corp, S corp, you know, S corp helps you deduct losses, but, you know, this is a benefit. And it has to be certain business in certain specified fields. Again, accounting or law is not allowed, but, you know, all the things you're doing are allowed. And you have to have assets of less than 50 million, so, you know. For example, when PEMSTAR, they qualified for this, so some of the people who initially invested in that, you know, got a benefit from this provision. So it's one that you don't wanna forget about in terms of an exit strategy if you're a C corporation.
So you invest 100K and it turns into 100 million, or let's say 10 million. You'd have a gain of about 10 million of capital gains essentially. And so that would reduce, and capital gains would be 15%.
It's funny, basically in that example, and it's a good example because there is a limit of 10 million. So if you grew to 100 million, the first 10 would qualify.
Only 10, yeah.
You can exclude half of the 10, so
Yeah.
it'd be $5 million. But it's taxed at a higher rate.
It
It's
is.
taxed instead of, the old rules, instead of a 15, it was taxed at 28. So you think about,
So 1%.
yeah, basically it would be 14. But the thing is that in Minnesota, they don't have any adjustment. So it actually saves a whole lot more in Minnesota
Okay.
than on
Okay.
federal, so.
Okay.
But, But those are sort of the general things,
It's
you
really
know.
helpful, that's a great page.
So,
Oh, sure.
yeah, if you want some extras, we passed out some cards. If you have any questions, give us a call.
You could maybe leave a stack. on our
Yeah,
table
Yeah, that'd be
here.
nice.
Yeah, yeah,
Okay.
that's really nice.
And then I think there's, if you have any questions, we'll hang around. I think maybe it was you guys had asked ahead of time, so we were planning on spending
Yeah, just a few moments.
a few minutes with you. But we're be glad to address anything.
This was